This is The Big Three from the Coalition for a Prosperous America with senior economists Mihir Torsekar and Andrew Rechenberg.
China's dominance of EVs, batteries, and solar panels is one of the most surprising economic stories of the 2020s. But the bigger story is what underpins it. China has built an industrial system where cheap thermal power, dominant metals processing, and the world's largest manufacturing base reinforce each other. But that system didn't emerge from a master plan. Local government incentives and cheap credit to state-owned enterprises drove a build-out that often outran domestic demand. The excess flows out as exports, and China now produces almost anything that runs on electric current, and the advantage is harder to replicate than analysts expected. The result is what Rhodium Group analyst Rogan Quinn calls an electrostate, and he's here today to walk us through the mechanics of that system. You won't want to miss it. So welcome to the Big Three from the Coalition for a Prosperous America, where each week we break down the three biggest stories shaping U.S. trade, industrial policy, and the American economy. I'm Mihir Torsekar, and I'm joined by my fellow senior economist, Andrew Rechenberg. So let's get to it. So, Rogan, before we get started with the show, first I want to welcome you to the program and give you a chance to really talk a little bit about your work at Rhodium Group, what brought you to writing this latest report called Minerals, Metals, and Megawatts, how China's power generation drives its industrial metals ecosystem.
Great, and thank you both for having me. It's really great to be here, and I'm happy to talk about the paper. So my position at Rhodium Group focuses on macroeconomics, and subcategory I look at the industrial ecosystem, particularly metals demand, major metals on behalf of financial institutions, corporations. I came to Rhodium Group after completing my MBA in Shanghai. It was the European Commission and the Chinese government created a joint venture called SEEBS. Before that, I had worked in institutional investment consulting, as well as global economic development. The joke I like to say is I left Haiti and cholera broke out. I left I left Sierra Leone and Ebola broke out. And then shortly after I left China, COVID broke out. So I've had some trouble with travel. But broadly, I've been passionate about economic development, and how countries get on the motive to grow and betterment of people's lives. And in China always stood out to me. I did my undergraduate exchange at Fudan University and then decided to pursue my MBA in the same city of Shanghai because I had such a wonderful time.
Amazing. That's great.
Yeah, and I think that gets us exactly where we're looking for the first segment of this on the electrostate in China. One of the main concepts in your report is that China has become an electric state. I think this is really one of the main chokeholds that we're seeing in the system at this point. And so, for example, when people hear critical minerals, they usually think of it like oil, where the resource is, where it's coming from out of the ground. But your report suggests that it's actually what happens after it comes out of the ground that's actually most important in the system. So I was wondering if you could walk us through what do you mean by an electrostate and what does China's version of this electrostate look like in comparison to some of the older models of resource power?
Sure. So I think that this phrase electrostate can take on a tremendous number of meanings. And what I think the report does well is first it points out that China's industrial system has been driven by access to power. That power has primarily come from thermal coal, often supplemented by hydroelectric. On an annual basis, it's often growing at a size of Germany. And all of these energy-intensive industries put China in a tremendously advantageous position for the new growth sectors associated with renewables because material synthesis, separation, refining are all energy-intensive. Metals is the most energy-intensive industry, and it often is high volume, low margin, and difficult to compete. So China's position here, producing large volumes of metals, but also consuming them, has created an environment that's very conducive for incremental innovation in regards to electric vehicles or robotics, many of the industries that we're looking to for the future.
So, question I had. So the electrostate's processing dominance you talk about like extends upstream into mining. This is one thing you mentioned. So, you mentioned in the report China is the largest producer of 19 of the 20 most critical metals for electrification. And even like the one exception is nickel in Indonesia, but that's built by Chinese engineers and owned by Chinese firms. So if you could maybe walk us through how that mining position actually developed, and because there was this other thing you talked about, it seemed like there was parts of the policy that was and the plan out that was intentional, and part that almost seemed like a happy accident and maybe you could talk a little bit about that.
Sure. I think that one thing that's challenging in the mining space, in the global environment, has always been you cannot control your natural endowments. So, concentration of mineral resources in specific jurisdictions creates tremendous risks for certain players. And in many of those jurisdictions, China has passed those political risks and created investments, built infrastructure necessary for extraction purposes, built relationships with governments that often are changing. None stands out more than the bauxite in Guinea and the build out of the railway there, in terms of gathering greater amounts of iron ore. There's been political changes in Guinea over the last 5 years that would push away many potential investors. And so the willingness to engage, I think, is the step one. The risk taking, China's policy banks would be step two. The capacities domestically and expertise in processing of complicated concentrates, the ability to extract greater amounts of minor metals, the know-how to do so in a cost-effective way, and then downstream having the demand either in synthesis or fabrication manufacturing, enables the system to continuously expand and incorporate greater amounts of the global industrial base as it relates to metals and materials.
Yeah, on the mining story, it just seems so interesting. The fact that they might have set out to process some of the principal or primary metals, and then as a result, and maybe through the byproduct of that refining process, you create maybe, is it non-primary metals that are basically then you have in place, but now they also address the demand side of it because their downstream sectors, the TVs, the smartphones, that industry now needs those things that might have otherwise be discarded and left on the cutting room floor because they're just not profitable to mine. But now you have a ready demand signal for it. It strikes me that was that part of like kind of an accidental benefit then, or is that because that just doesn't seem like it was intentional or planned.
I think that there are a few important caveats here. One is most of China is new in relative terms. And so many of the technologies developed over the last 40 years to improve things like the amount of sulfur gas coming from a copper refinery that goes into, what makes everybody upset about the stinky egg smell. These things can be captured and that capture can be turned into a revenue stream. So right now in the global environment, sulfuric acid shortages are critically important for refining metals like copper and nickel, silver, gold, but also for things like fertilizer supply chains. China is the largest processor of phosphate rock. And so without phosphate, K, P, and N, potash, nitrogen, and phosphate, we can't sustain 9 billion people on the planet. And so the intensity of sulfuric acid in the fertilizer space can drive incentives for copper refiners to capture more of that sulfur gas and then transfer that into sulfuric acid. The other part of this too that China has had long-term experience in would be things like processing rare earths, which for a very long time, went into things like our Tycho RC motors rather than our drones or electric vehicles or wind turbines. And so China had an expertise in separation, capturing some of the revenue streams from these complex concentrates. And so adding that type of capacity onto smelters was something that China was well positioned for based off of the rest of the industrial system.
And I think this gets us exactly where we want to be for segment 2 of this, for the offtake demand engine. And I think this, from your report, is really what's keeping the machine running in China for a lot of these supplies. And a lot of times we think of the Chinese system as more of a supply system, that they have all the refineries, the smelters, they have all this cheap power. But in your report, you really highlighted also how the demand side within China also plays such a huge role in this, that it's the demand for these critical minerals or other things that go into things like electronics. And can you explain a bit more of why this is so important for the Chinese system as well, and how this demand and supply side are so linked?
I think one of the best examples in this supply versus demand side economics is batteries, because they've become such a critical component of all technologies, whether you're talking about data centers or renewable energy, intermittency issues, or transport. But in that space, 30 years ago, we had, our first cell phones coming out, and those required batteries that could last a longer period of time and be recharged, hundreds of times before failing. And so what we're dealing with now is just a massive scaling up of those capacities, and then some substitution of certain components. One in particular is nickel, manganese, cobalt, high energy density batteries for less energy dense but far cheaper LFP. So by removing the nickel and cobalt from the cathode material and substituting that for the abundant lithium iron and phosphate, China was able to drive down battery costs, which expands the number of use cases. You can think of it now as a way of preheating your oven much faster, because you can increase the voltage being going into the oven relative to what's coming out of the wall. And so the use cases of batteries expands with the reduction in cost. But what China's industry is built for is substituting certain materials for others in a incremental innovation way, which enables faster iteration in terms of production. And so over the last 3 to 5 years, China's battery production has grown exponentially, and largely due to the number of use cases and the reduction in costs, or the reduction in costs resulting in an expansion of use cases. Now we're talking about heavy duty trucks in China being close to 20-25% of total sales. I could see that number jumping to the mid 30s this year, because, in 12 to 14 months, you can replace your chassis in that industry, and all of the costs associated with it, by switching from diesel to batteries. And in the current environment, it's very attractive for players to think about that. All that being said, I think that there are going to be limitations on the capacity of China to reduce costs across the board, and that electrification as an idea is amazing, but one of the consequences is you will create material constraints because of the demands associated with those technologies.
Well, even within the discussion of demand, it occurs to me that even as, the report talks about how prolific China is in their industrial build out and their, electrification process, it just occurs to me that there's a vulnerability that lurks in the system here, and that is the fact that they are so dependent on external markets overseas to sustain this engine, because so little of what they're producing is consumed. Or at least maybe I'll push back on that, actually, because on the renewable side, they are doing a lot of solar installations and wind installations, but it's just never going to keep up with as much production as they're putting online. It just seems like there's this engine that's just that just can't turn off. And are you able to maybe talk a little bit about that vulnerability that kind of exists in the system? Because, for example, we're seeing this big supply shock in energy markets and how it's roiling. We still haven't seen what the play out of the Middle Eastern conflict might be on demand and things like that. But any kind of external shock to global demand seems like could undermine this entire system. Is that maybe it's something that you feel like you can maybe speak about, or just on the margins, however you feel comfortable talking about that a little bit?
100%. So I think that when we think about the current oil shock, there's competing forces. The first is for those that can afford to swap They may have encouraging signs of greater usage of solar panels, solar plus storage, moving to an EV in terms of new sales. But ultimately, when you think about a change in patterns of consumption, the first order effect right now is that we went from, let's say, $60 a barrel to $90 a barrel, $30 a day. That would be, $30 per barrel, 100 million barrels per day. You're talking about $1 trillion in lost sales in a year. And if that is substituted for other types of consumption, that's a negative headwind to many of Chinese exports. If you're in the growing global middle class and you were planning on buying more clothes this year, but your energy bills have gone up, Chinese textile exports would go down. So there are ways in which this type of oil shock is a headwind to Chinese demand as much as it is a tailwind. I think when we talk about something that could disrupt China's entire industrial ecosystem and the marginal dependence on the rest of the world, there's certainly a case to be made that China's industrial ecosystem is more vulnerable to a global recession than it is to U.S. tariffs. Because many of the nodes in which China dominates are far upstream. And so what you have is Chinese industrial players moving certain nodes of assembly to third markets, which enable access to end markets like the United States or Europe. They also engage, and this is in two-way trade, engage in transshipments, whether that's, sending copper concentrates through Thailand and then Thailand to China to avoid Chinese tariffs, or sending complete products to Vietnam and restamping them, relabeling them, and moving them to the United States. There's a large amount of that type of activity going on in both directions of trade to avoid the cost of tariffs. And so some of that, what I would label as logistical costs associated with tariffs, cannot, change the dynamics entirely. But certainly I believe that a global slowdown in consumption would be detrimental to the Chinese system. And one of the ways to think about that is China's credit system has grown tremendous rates over the last 15 years, and it's now starting to slow down. There's tremendously weak cash flows associated with a lot of these businesses, and you're building minor metals refining businesses that are supposed to be financed over a 30 to 50 year period because that's how long these facilities go. But if the cash flows associated with them get cut in half, whether it's because the end demand offtake isn't there, or there's a decline in prices because we have a global supply glut in certain metals like gallium, for example, you would see parts of the Chinese industrial ecosystem start to suffer because of it. And so, in essence, I would say that China's export reliance is significant. It's not world ending in many ways for them, but it certainly would be one of the biggest headwinds to the economy when you have weak retail sales in China growing at 2%, and then a slowdown in major industrialized economies' demands for Chinese products because of the economic slowdown within that country. Certainly, I think it's a huge case.
Yeah, I think we might already be then well positioned to kind of pivot to the third topic of discussion for today, which is like the risks inside the system itself. And we might have already touched on it a little bit, but the structural risks and the cost dynamics. But one thing and one thing that occurs to me is like, and I just wonder how much of this is also intentional, like China's dominance of so many, so much mining and refining of critical minerals and rare earths and elements like that, it gives that such tremendous power over over pricing power, and just just being able to flood the market with supply to discourage any kind of mining from Western countries or anything like that. They've just become the only game in town here. I'm wondering if you can talk, was that, you feel like that was, intentional, intended to try to achieve some sort of geopolitical leverage? Because it occurs to me that so much of their posture has been about trying to achieve self-sufficiency, but it seems at the same time they've been able to develop these geopolitical tools by developing these choke points. And maybe if you can talk about that a little bit.
Sure. I mean, in a more natural level, I think, one of the things that I found very interesting about business school in China was how relevant KPIs were. You had key performance indicators. So it's like everything had a KPI. And one of the KPIs I think that local government officials were dealt was GDP growth. This is our number one KPI for a long, long time. And one of the ways in which you can create GDP growth most effectively is by increasing the power generation and then increasing the use of that power. So it's like a double whammy in terms of GDP statistics. You have this tremendous amount of output in terms of energy generation, and then you have this tremendous amount of consumption in terms of energy consumption for these industries. And then downstream, you'll have another layer of manufacturers. The easiest one to talk about is Nexans and Glencore in Montreal. And the challenges that these types of trade relationships create is that Nexans put their manufacturing of copper rod about 100 meters away from the Glencore copper refinery. And the reasoning to do that is because by co-locating these two industries, I can reduce the costs of logistics between the two of them. If I'm transferring this cathode into rod and I, let's say, have a 3% scrap rate, I can send that right across the street back to the previous step of the manufacturing process. And so in the Chinese economy, you have not only the refinery, the smelter, but then you have the rod manufacturer. And then the guy downstream from that is insulating wire and cable. And that insulated wire and cable then creates demand for plastic coating. And then that goes into, your grids, your electric vehicles, the walls of buildings, et cetera, et cetera, et cetera. And so I think that the KPI of economic growth, the energy intensity of a lot of this processing was the primary factor of major metals development in China. I think that infrastructure and use of those things was another, how this snowball or this ball, snowballs and grows into something much larger, just like you see with the rod manufacturing or fabrication. The challenges in the global environment, in my opinion, aren't in the major metals areas. They're in the minor metals areas. So when we talk about gallium, germanium, indium, tellurium, interestingly, none of these are coming from your rare earth set, right? So there's like 90 metals. The major metals that are traded on exchange are much smaller in terms of the number relative to the total amount of these random things that no one ever talks about, but if you broke down your cell phone, would have to find them. That build on to these major facilities to process these metals, like gallium, come after you've built or when you build the aluminum plant, the zinc plant. Some of this results also from natural endowments of things like zinc in China. But ultimately, the production of those minor metals can be incentivized by price or demand. So if I'm going to build a major consumer set for these metals, semiconductors in some cases, then I'm going to want to ensure that the materials going into those don't end up in tailings. Because then I can maximize my GDP as a local government official. I can maximize the output. And it's not necessarily built on whether or not the capital returns look that attractive. And so the KPIs, I think, in China aren't necessarily aligned with global dominance. They're aligned with local government officials hitting a number and getting a promotion. What that means now is something completely different. As the world gets into this area of resource, endowment, technology nationalism, I think that you have a breakdown of some of the things we took advantage for the last 40 years. And so China's position is strong. It doesn't seem intended to me. And now it is a point of leverage.
Absolutely.
Yeah, and then I also wanted to ask, so the report also talks about some other countries and what they're doing in the supply chain outside of China. For example, Japan and South Korea, you describe them as fixer countries, where they don't necessarily or they're not sitting on the minerals themselves, but their strengths lie further down the supply chain. So I was curious, what are these countries doing that's different from what China's doing, and how have they been able to be successful in some of these supply chains when countries like the U.S. or Europe have been a little bit further behind?
I think these two fictions approach things very differently. What we saw with the IRA was a massive response from China or from Korean battery manufacturers. LGES and LG Energy Solutions was probably the largest. Then Samsung, SK On planned on building large battery manufacturing plants that relied on primarily on NMC cathode materials in the United States for the potential build out of the EV sector. And so some of the challenges they face now is that NMC isn't as good of a fit with battery storage, stationary storage, as something like LFP would be. But their response was, you provided me an incentive and a downstream demand source, and I provided a technology and a know-how into your market to meet your requests. They even went as far as to reduce the Chinese ownership of certain partners in order to qualify for IRA-related subsidies. The Japanese case is a little bit different because it's independent. It is long-term, and it's structured in a way that is challenging to replicate. So the Sogo Shosha, I'm butchering that phrase, is for Japanese trading houses. And one of the most well-known contracts that they have is an offtake agreement with Linus. So JOGMEC is a Japanese government entity, Japanese Organization for Metals and Energy Security. And then you have Sojitz, which is one of these trading houses. And so what's different about Japanese trading houses is they go raw materials to finished product, and they can sell you anything in between. So it's like being a wholesaler of entire industrial supply chains. If you want to buy copper rod and insulate it in Vietnam, I'm more than happy to sell it to you. If you want to buy copper cathode and turn it into tubes yourself, I can sell it to you. You have a demand, I have a price. And so the trading houses operate in this world where they primarily meet the needs of the other downstream manufacturing and industrial enterprises in Japan. Think of Toyota, for example. But they also de-risk projects in conjunction with JOGMEC. And so the Linus story is of interest because following China's restrictions on magnets to Japan about 15 years ago, they decided to create this offtake agreement with Linus, who is operating in Malaysia, but it's an Australian mining company. And so, I like to say that with rare earths, what do you say? Uranium is in deposits, and thorium comes with your loose change. The loose change is all of these random, small volume, very critical metals that go into all of our high-tech products. But the particular ones were these magnets. And so the separation of that thorium is a major challenge for dealing with what do I produce that I don't want to deal with? And the second part is the chemicals. So these are toxic chemicals that you don't know how to dispose of. And so de-risking projects can involve not only government intervention, but also finding jurisdictions and environmental, for a lack of a better term, avoiding developed country environmental rules. And so some of these issues in which the trading houses have developed capacities to create solutions to complex problems is in partnership with the Japanese government. And so because these trading houses have been a part of Japanese development strategy since World War II, they've also had a strong relationship with the government in an ability to build these capacities in a way that's difficult to replicate solely on the basis that they work from the mine to the finished product.
Yeah, the Japan story is kind of interesting because they really were in the front lines of the early stages of this sort of maybe weaponization strategy of, of China when China. They had like a geopolitical dispute back in 2010, and China really previewed this playbook on weaponizing their rare earth dominance. And Japan at the time, as I recall, I think it was like 90% reliant on Chinese supply. And then through the course of some of the investments that they've made and the prioritization of the industry, it seems like they've been able to wean themselves slightly away. I think last I saw was something about 60% reliant on China. So there's still a substantial reliance, but interesting thought for Andrew and me to maybe think about when we talk to our members is just maybe there's hope perhaps for the U.S. in looking at that. Maybe that provides a playbook on what could potentially happen if we want to try to, replicate what Japan's doing. I don't know if that's even possible, but that just occurred to me that's, that would be nice. There's some reason for optimism perhaps. So listen, this has been really great, Rogan. Thank you so much for your time. Before we let you go, I guess I wanted to ask you maybe if there's one maybe analytical point or takeaway from the report that you'd want to leave our listeners to walk away with.
I think that the challenge that goes unspoken is producing large, abundant amounts of cheap energy for developing industrial ecosystems outside of China, because you have to find where on this supply chain you want to compete. And if the objective is to leverage the U.S. consumer's pocketbook in order to create a demand side for this potential supply chain, the challenge is the consumer in the United States is eventually constrained, and the amount of sales you can make of more expensive goods is lower. And so these trade-offs are real, but fundamentally what it will always come back to, especially in the developed world, is how cheap I can produce power in order to make the raw materials into something valuable. And I think that fundamentally, if we can address that, we'll be able to compete on almost any vertical.
Great. Well, Rogan, thank you so much for joining us. So to our listeners at home, the report Minerals, Metals, and Megawatts, How China's Power Generation Drives Its Industrial Metals Ecosystem is up at rhodiumgroup.com, and we'll link it in the show notes. So you can learn more about our work at prosperousamerica.org, and be sure to find us on YouTube, and you can check out the Big Three on Apple, Spotify, Google, or wherever you get your podcasts. For now, we're signing off. Take care.